All right, so good morning, you all. Technically, this is the last subtopic of our syllabus. Um, it is about uh, fighting against the assumption of no taxes. Remember when we started studying some of the theoretical parts like CAPM, we assumed that we live in a utopian world in an era when there are no taxes. But taxes are reality. Tax is a very big reality, or rather a harsh reality. We have to pay it. And then come the capital structure, and then come Modigliani and Miller, who say that there is we're not very biased in favor of one form of financing to other. But then we proved them wrong, that no, it's not truth. As long as there are taxes, the corporate tax, the one form of financing would always be preferred over the other form of financing. And that is debt would be preferred over equity. But of course, debt has its own cost. And that we studied in the topic called debt capacity. But I must admit that in so far discussion that we have had about taxation, our discussion is only 50%, because we only considered one form of taxes, and that is called corporate tax rate, the taxes which the companies are paying. But in reality, we go through two forms of taxation. We also go through our personal taxes. I am very sure, and I hope you are aware of this fact, that every year we file the income tax return, don't we? Our individual tax return. So that basically is calculation of the income, your salary, if you get some rental income, if you get some dividends, if you get some interest from the bank, if you have any other form, if you do some private consultancy. So all your incomes are added. And then the taxman is calculating that what is the rebate, what is the standard deduction, and how much your income, your total, the revenue that you earn is taxable. And then depending upon you falling in the low tax category or high tax category, you pay the income tax. It means that if you are earning dividend, which means the share of profit of the company, you should be facing two tiers of taxes. The one is that the company is paying tax, the corporate tax, to the taxman on your behalf. In other words, had the company not paid corporate tax, that amount of money should have gone to the shareholders. It means that basically that's a hole in your pocket. The shareholders. And then at the end of the year, your total income is calculated and you get a very long kind of document from the taxman, and he says, all right, we have added all your income from all sources, all the rebates, all the exemptions have been given to you, all the deductions have been made, and by the way, this is what you owe still to us. And that is called your personal tax. Sometimes you end up paying more and you get the rebate. But anyway, you come across, you have to go through this process of the personal tax system as well. In the discussion which makes debt cheaper than equity, we have been ignoring on purpose the personal income tax. The personal income tax can be a neutralizer. In many countries, let me explain it. What do I mean by neutralizer? In many countries, we find that the tax is more on the equity income, and there is a tax debate on the interest income. It means that the corporate tax rate, the corporate tax system is biased in favor of the debt investors and is biased against equity investor. Now, if you are discriminatory against the equity investors and you are favorable again for the debt investor, it could be possible that all the people like to invest in debt than equity. Isn't so? It could be possible. In that case, we have to find some neutralizer. That, hey, if the corporate tax is biased in favor of debt investors, then the personal income tax is biased in favor of equity investors, so that it's a balance created. In many countries, I can give you an example of Singapore. I lived there for some time. In Singapore, if you are earning interest income, you pay, I think, 7 to 8% tax, because tax in general are very low in Singapore. But if you are getting any capital gains or dividend income, the tax rate is nearly 0%. See, the interest investor, the debt investor is paying around 7 to 8%, but the equity investor is paying nothing on for the income he or she earned from equity investment. Or for the capital gains, that you buy a share for 10 euros and you sell for 20, you make a capital gain of 10, no tax at all. It means what? It means that the taxman wants to be some kind of neutralizer, that, all right, I treated harshly the equity investors. All right, now, when it comes to corporate tax rate, but when it comes to the personal tax rate, I would like to give some kind of favorable treatment to the equity shareholders. And that could bring you in a situation when the final income which is left with you as a debt investor is same as the final income left with the equity investor. And this final income, we have a word in economics for this final income. It's called personal disposable income. Personal disposable income means that income which only you and only you have claim over. All taxes paid, all fees paid, everything is paid. That money belongs to you. You go and spend the way you want. That is called disposable income. So it could be possible that the equity investor go through two types of taxes: the corporate tax rate and the personal income tax rate. The debt investor goes through only one form of tax, that is the personal income tax, because the interest is paid before the company pays the tax. So, but it could be possible that the amount of tax the debt investors are paying is so much that it is equal to the 2 times taxes paid by the equity investors. So that we are having an optimum level, that whether you are, okay, this group of people are debt investors, that group of people are equity investors. The debt investors only pay one tax, that is the personal income tax. The equity investors pay 2 times taxes, the corporate tax rate and the personal income tax rate. But if you start with €1 each, the debt investors go through one form of tax, the equity investors go through 2 forms of taxes, but finally, when you are receiving your disposable income, that is equal to, that is same, basically. So that's a very optimum form of taxes, when the overall tax system is not treating one form of financing better than the other, better or worse than the other. So if that is true, then in many senses, the Modigliani and Miller proposition turns true, because they also say that it doesn't matter the way you finance. Why did we challenge Modigliani and Miller? Because we said that, hey, the corporate tax rate is more in favor of the debt investment. But if the personal income tax is in favor of equity investment, then they are neutralized. And at the end of the day, you are getting the same cash flows. So if that is true, then Modigliani and Miller are not wrong, by the way. Their theories are taught in the universities deservingly. That is my thesis, that's my point, and that is what I would prove with an example soon. But because you raised hands, so I want to give you an example which is not about finance. Okay. I organize an exam here, okay, just for the sake of. And somehow I found that I'm giving you different questions. You have 4 here. I give you question, 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 and a question. But the question which you get is damn difficult, right? Their questions are at par. They're different, but pretty much same level. But your question is, maybe it's my fault. It happened to be a very difficult question. Did I treat you favorably? No. So what should I do then? Then next time when I may give you assignment to everybody, I should compensate you with some easy assignment. That's called neutralizer. Make sense? So if the corporate tax system is falling heavily on the equity investors, then the personal income tax should be more in favor of equity investors, so that it acts as a neutralizer. Do you get my point or not? So that is called neutralizer. All right, so I think it'll be clear when I give you an example. Here we go. This slide I took from the Brilliant Myers book. Just see, the operating income is 1. Can you see it? Yeah. It means that whether you are a debt investor or an equity investor, the company's operating income is 1. And then this $1 is given to you as a debt investor. Can you see the arrow going paid out to as interest? Okay. When you get the same amount of the operating income as $1, the corporate tax impact on the interest income is none. Do you agree? Whenever you don't agree, please ask me. It means that the income after tax is 1 because there is no corporate tax. And let's say the personal income tax is TP. Can you see here? T subscript P. TP is the personal income tax which you pay on your individual income, not the company paying, because company is not paying any tax on the interest. Agree? It means that your income after all taxes, which I use the phrase, I took it from economics, disposable income. Disposable income is 1 minus TP. 1 minus TP, all right? Make sense? Now go to the arrowhead again. Operating income is still €1. This time is paid out to as equity income. Yeah? Make sense? And for the equity income, will there be corporate tax or not? Will there be corporate tax or not? For the equity income? Yes or no? Yes, it's TC. Yeah? It means that the income after corporate tax left with the equity investor is 1 minus TC. Yeah? Now, does it mean that the personal income tax will not fall on the equity investor? No, he will pay personal income tax on whatever income he gets from the company. And how much income he gets from the company? 1 minus TC. So you are paying, I just separate it with another letter PE. So it's a TPE means the personal income tax on equity income. TPE falls on 1 minus TC. And when you solve this bracket, it comes out to be this equation, something like this. So basically, the income to the debt holder, the bond holder, same word, is 1 minus TP. And the disposable income that goes to the equity holder or shareholder or the stockholder is 1 minus TPE in one bracket and 1 minus TC. That's the sort of mathematical equation. If you want, I can solve it on the board, but it's pretty straightforward. So this is what we get. And it could be possible that both sides of the equation are equal. So for example, now I think I have to draw it on the board. If I maybe I draw on the, wait a sec, I think that'll be very clear if I'm just taking a pause, yeah? So 1 minus TP and then it's equal to 1 minus TPC, TPE, and 1 minus TC. Okay, now I'm going to draw something for you. New share, the whiteboard, the text. So for example, if you are a equity holder, if you're a bond holder or the debt holder, bond holder or debt holder, whatever, it doesn't matter. In that case, what you get is basically is 1 minus TP. Yeah, the personal income tax. That's what you get. This is your disposable income. So I should even write here that disposable income is disposable income of, and I repeat, disposable income is the income which you get after all taxes, everything is done, basically. So there is nothing else you need to pay. 1 minus T, what is the word? T, oh, TP, the personal income tax rate, okay. Here we go. And then we have one more text box. And then the disposable income. Disposable income of equity holder or the shareholder, stockholder, whatever you want to say, is basically equal to 1 minus TPE. And I'm using TPE as the personal income tax on equity income and multiply by 1 minus TC. And I hope you remember this expression. TC is basically your, what do we call it? The corporate tax rate. Now, this is the situation. Now, it could be possible that the, how do I get the symbol? Is there any way to get the sign or the No? Okay. So it could be possible that both sides are equal. So if they're equal, then you have the very optimum and the fair taxation system that finally, at the end of the day, the disposable income of both type of investors is same. And if it is higher, so there is a larger sign, you know, a greater than sign, it means that the tax overall is tilted in favor of the debt investors. Because if the disposable income of the bondholder / debt holder is higher than the disposable income of equity holders, it means that the tax is definitely biased in favor of bondholder. And if it is the situation that it's lower, the left side is lower than the right side, then even though the equity income, the equity holders are paying tax twice, but they at the end of the day have larger income than the larger disposable income than the debt holders. Okay, just focus on this line. If this is equal, this equal means that the left side and the right side, disposable income of bondholder and disposable income of equity holder is same. If that is the case, then you have a very fair and just taxation system that you treat both types of investors overall equally, because both investors, their disposable income is same. At the end of the day, at the end of the year, when all taxes, all types of things are paid, they get same cash flow. But if there is a higher sign, I was wondering if is there any way I could put the sign here. If the sign is greater than here, greater than or higher or greater than, it means that disposable income of bondholder is higher or greater than disposable income of equity holder. In that case, the country's tax regime is biased in favor of bondholder and is biased against the equity holders. Okay, and if this is lower, which means that the disposable income of the bondholder is lower than the disposable income of equity holders, it means that the tax system is biased in favor of equity investment. I wish I could write here equal to sign. Here I could write greater than sign, and here I could write the less than sign. So no, not possible here. Huh? Well, I can actually. If I, for instance, if for example I have a Word file, if I have a Word file, stop sharing it. And if I have a new share, for example, oh, this is crazy. Is there any way I can share it? Document, yeah, there we go. So if, for example, if I disposable income of debt holders is equal to disposable income of equity holders. And how do you get the disposable income? Well, for the debt holders, you get like 1 minus TP, or yeah, the personal income tax. And for the equity holders, you get 1 minus TPE multiplied by 1 minus TC. So if that is the case, then you can say that overall the tax regime, the tax system is fair to both types of financing. And if that is the case, then in many senses, Modigliani and Miller are right, because it doesn't matter, because at the end of the day, investor gets the same amount of cash flows, whether he's an equity investor or debt investor. So one form of financing is same as the other form of financing. So if that is the case, if this happens equal to sign, then Modigliani and Miller are right, actually. But if the situation, so this is case one, and now let's discuss case two. So I just copy and paste the same thing and write it down here. If this is the case now, and here, so let's call it case two. And here, the sign is this one, insert symbols more than. Insert symbol more than. Then if that is the case, if the things happen like this, if the equation 1 minus TP bracket is greater than the other side of the equation, then I would say that the overall the tax system is biased in favor of debt and against equity financing. And then Modigliani and Miller are wrong again. So it happens the situation to situation. And if I have case 3, I copy and paste this text basically. And that's called case 3 or situation 3. But in the situation 3 or the case 3, the sign between the two sides is not greater than, but less than. Symbol less than, yeah. Symbol less than, yeah. So in that case, you can see that on the right side, the tax is falling twice, but despite that, the left side, the 1 minus TP, the money that goes to debt holder is still less than the money, the disposable income of equity holder, even though equity holders are paying tax twice. It could be possible that the tax rate which the debt holder are paying, even though they pay tax once, the tax rate is so high that even though the equity holders are paying tax twice, but they pay less percentage of tax. So it could be possible. So in this case, the tax system is biased in favor of equity investment, equity financing, and is against the debt financing. So in that case, once again, we can prove Modigliani and Miller wrong. So this is the magical situation. Case 1 is a magical situation when we can say that the Modigliani and Miller proposition comes to be, just a sec, comes to be true. So this is the only situation when here Modigliani-Miller proposition is true. So this is the theory says. Can you see this? Is it visible to you? Yeah, good. Okay. So this is the situation when Modigliani and Miller proposition comes true. Yep.
But shouldn't the disposable income shouldn't be higher for equity investors because they bear a higher risk?
Yeah. Well, in that case, if that is the case, then this situation will go up. I mean, everything is possible. It depends upon the tax system, the tax regime. If the tax regime want to create this situation, like case 3, in case 3, the overall disposable income of equity holder is more. I understand your point that why should always be not this more, because they take less risk. Well, equity financing is risky, but in many countries, the debt financing is equally risky too.
Like the equity investor gets when the company goes bankrupt,
Mm-hmm.
the equity investor gets the money at last.
Yeah,
so,
pecking order, yes.
So it's normally the interest, the final interest of a debt investor should be lower than the final interest of an equity investor.
I truly agree with you. But in many countries, in the pecking order, there are many stakeholders in the pecking order. Okay, and if the 10 stakeholders in the pecking order, then the debt investors could be 9th and equity investor could be 10th. So there is hardly any marginal difference left between debt. If there are 4 or 5 and debt and equity investor are either first and second or second and third or third and fourth, then I can understand the point. But when there are many stakeholders and these poor investors are at the rock bottom, it doesn't matter who comes first. Nothing is left for them anyways. Then the marginal difference between them. Whenever there's a World Cup football, a team comes first and the team comes second. The marginal difference between first and second is huge. One is a winner, the other is a loser, right? Don't forget this, the team which comes second in the World Cup has beaten all other teams up till the final match. But in many sports, like I don't know, in football it doesn't happen, but in hockey, for example, field hockey, I used to play in India. In field hockey, there are 12 teams taking participation in the World Cup, and there's a qualifying matches for the 11th and 12th position also. You get my point? 4 teams go to semi-final, 8 are left. They play who comes 5th, 6th, 7th, 8th, 9th, 10th, 11th. The gap between the team which comes 11th and 12th is hardly anything. You get my point? The marginal gap between the winner and the loser in the final is huge. Whereas the marginal gap between who comes 11th and 12th is negligible. So it depends upon I understand in theory, you're right. But then don't forget that finance is not all dealt by the finance people. Finance is dealt by these legal, now this is a legal system of the country, making law, bankruptcy law, tax law. The people have the financial and the accounting bent of mind, but don't forget, they are lawyers, basically. They are the legal people, basically, right? So it could be possible that you are right from the financial logic, but when it comes to the legal side, they don't want to make any difference between the two. Yeah. Okay, where are we? Now I want to go back to the slides. I want to give you one example before we close. Yeah. A numeric example. Have a look, this example. Yeah, so this is the same ratio, that doesn't matter. Income before tax for the interest. Can you see the slide? Yeah. The income before, for the debt holder, the interest income is $1. The corporate tax rate is 46%, but he will not pay any tax because there is no tax on the interest. So 1 minus 0, so there is 0 tax cash outflow. The income after corporate tax is 1. Let's say the personal income tax on the equity owner, the debt investor is 50%. It means that 1 minus 50 is 50. So it means that the debt holder at his disposable income is 50 cents. On the contrary, the equity income, that is still $1 for $1, but this equity investor has to go through the corporate tax rate hurdle, which is 46%. It means that the disposable income, not disposable income, the income after corporate tax is 54 cents, $1. And then the legal recognizing the fact that the TPE as 0%. You know what it means? It's like an acknowledgement that, hey, you guys have taken so much of risk in your life. I want to put no tax on you. No personal tax, no personal income tax rate on equity income. It means that you get 54. Yeah, make sense? And then we calculate a coefficient. It's called R, a relative tax advantage, which is equal to the cash flow going to the debt owner divided by the equity owner. And if this ratio is less than 1, which it is in this case, the advantage goes to equity owner. You can, even if you don't divide it, you can see very clearly that the disposable income of the debt holder is 50 cents and the disposable income of the equity owner is 54 cents. So obviously, in this tax system, the equity owner is a winner. Do you get my point? Is it fine? And in the second example, yeah, so this is in the second example, again, we start with $1 of interest income. Corporate tax rate this time is 34%, but the interest income bears no corporate tax. So 1 minus 0 is 1. The personal tax rate in this case is 28%. This example is even more interesting. I'll tell you why. It means that the debt owner disposable income is 72 cents. On the other hand, the equity income is 1. This time, hey, this time the corporate tax rate is lesser than before. It's 34%. Last time it was 46%. 34. So the income after corporate tax is 66 cents. And here again, mind it, here again, there is no tax on equity income. And you get 66 cents. So even though the tax system is biased in favor of equity owner, I mean, they are showing a generosity by not putting any tax on the personal income of the equity owner. There is no tax, but you know what? In this calculation, you can see that the carry home money of debt owner is 72 cents. And the carry home money of equity owner is 66 cents. So the disposable income of debt owner is more than the disposable income of the equity owner, even in this example, the personal tax rate on equity income is 0%. It just, the calculation goes in favor of the equity owner. And in this case, even the corporate tax rate was lower than the previous example. So despite your best intentions to favor the equity owner, the overall disposable income of debt owner is more than the disposable. But what can you do in this case? Well, what you can do is you can actually, maybe in this example, you could have increased the personal income tax, TP. If TP is more and TC is even less, then you can again favor the equity owner at the expense of the debt owner. Okay, well, legal system, you know what, the legal system largely depends upon the political will also, and sometimes the politicians, they don't make the good decisions. Yeah. So then we have a third example. So here again, so in this case, because the disposable income of debt owner is 72 cents and the disposable income of equity owner is 66 cents. So if you divide 72 by 66, the ratio is more, the coefficient is more than 1. Hence, the tax advantage goes to the debt owner. Even though you don't have to calculate it, so visible that the money disposable income of debt owner is more than the equity owner. So, and then we have one more example here. Well, you can create all type of example. But what lesson we learn is that if you really want to make a tax system pro equity income, then the corporate tax rate should be lower and the personal income tax on debt income should be higher. So even though the personal income tax on equity income is 0, even then, the debt owner can earn more money at the end of the year than the. We have seen one example, TPE was 0%, and even then, the debt owner earned more money. Do you see this example? Case 2, the situation 2. In this case, look at TPE. The personal income tax on equity owner is 0%, but despite this, the debt owner was able to get 72 cents and the equity owner was only getting 66 cents. So lowering the TPE is not enough. If you really want to be pro-equity investment, as you said that because equity people are taking more risk, then the corporate tax rate should be lower and the TP the one which falls on the debt income should be higher. Yeah. So this is how you can be. You can play. You can fine tune. Okay. Yeah. So here we go. So now we can actually pause.